FOMC, Federal Open Market Committee. FOMC stands for the Federal Open Market Committee. It is the group inside the Federal Reserve that sets interest rates. When FOMC raises rates, the US dollar usually rises because investors get paid more interest by holding dollars. But stocks and gold often fall because higher borrowing costs hurt companies and reduce demand for gold. If FOMC cuts rates, the dollar weakens, and risk assets like stocks and crypto often rise. In simple words, FOMC tells the world how expensive money will be, and that changes the value of everything else. NFP, non-farm payrolls. NFP means non-farm payrolls, the U.S. jobs report. It is released on the first Friday of every month. It shows how many new jobs were created, excluding farms. If job creation is strong, the dollar strengthens, because it signals a healthy economy. But if job creation is weak, the dollar falls. Gold and stocks may rise when jobs are weak, because weak jobs mean the Fed may cut rates to help growth. In short, NFP is a monthly health check of the U.S. labor market. CPI, Consumer Price Index. CPI stands for Consumer Price Index. It measures how fast consumer prices are rising, also called inflation. If CPI is higher than expected, inflation is hot. The Fed may raise rates to cool it down, so the dollar rises, but stocks and gold often fall. If CPI is lower than expected, the dollar weakens, and assets like gold, stocks, and crypto can rise. In simple terms, CPI tells us how expensive life is getting, and that shapes central bank decisions. PCE, personal consumption. Expenditures. PCE means personal consumption expenditures. The core PCE is the Fed's favorite inflation measure. If core PCE is high, the Fed fears inflation, so they keep interest rates higher for longer. That makes the dollar strong, but pressures stocks and gold. If core PCE is low, it supports cutting rates, which weakens the dollar and supports risky assets. PCE is basically another way to measure inflation. ECB, European Central Bank. ECB stands for the European Central Bank. It sets interest rates for the Eurozone. If the ECB raises rates, the euro gets stronger. If they cut rates, the euro gets weaker, because investors move money toward currencies with higher returns. ECB policy also affects the dollar through the euro to US dollar pair. In simple terms, ECB decisions decide the strength of the euro. BOE, Bank of England. BOE means Bank of England. It sets interest rates for the British pound. When BOE raises rates, the pound usually rises. When they cut rates, the pound usually falls. This is the same interest rate logic as the Fed or ECB. BOJ, Bank of Japan. BOJ stands for Bank of Japan. They have a very special role in global markets. For years, the BOJ has kept interest rates very low, sometimes negative. If they ever raise rates, the Japanese yen can jump strongly, because global investors borrow cheap yen and invest elsewhere. This is called the carry trade. So any policy change by BOJ can shake all markets, not just Japan. GDP, Gross Domestic Product. GDP means Gross Domestic Product. It measures the total value of all goods and services in a country. If GDP grows strongly, the currency rises, because strong growth attracts investment. But if GDP shrinks, the currency falls. GDP shows whether an economy is expanding or contracting. Unemployment rate. Unemployment rate shows how many people cannot find jobs. A low unemployment rate signals a healthy economy. This usually strengthens the currency. But if unemployment rises, it weakens the currency, because weaker job markets reduce spending and growth. ISM, Institute for Supply Management, PMI. ISM PMI stands for Purchasing Managers Index. There are two versions, manufacturing and services. A reading above 50 means expansion. A reading below 50 means contraction. Strong PMI supports the currency and stocks. Weak PMI signals slowdown and hurts the market. In simple words, PMI is an early warning of growth or recession. Retail sales. Retail sales measure how much consumers are spending in stores. Strong retail sales push the currency higher, because consumer spending drives most of the economy. Weak retail sales drag the currency lower. In simple terms, retail sales tell us how confident people are to spend. OPEC, Organization of the Petroleum, Exporting Countries. OPEC is a group of major oil-producing countries. They meet to decide how much oil to pump. If OPEC cuts supply, oil prices rise. If OPEC increases supply, oil prices fall. Oil decisions also affect currencies of oil-exporting countries, like the Canadian dollar, Russian ruble, and Norwegian krone. Jackson Hole Symposium. Jackson Hole is a yearly meeting of central bankers and economists. It happens in the US every August. Here, leaders like the Fed chair share their long-term outlook. Even one speech can shake markets worldwide. Speeches by central bankers. Not just events, but speeches matter too. If the Fed chair sounds aggressive about inflation, the dollar rises. If he sounds soft, the dollar weakens. The same applies to ECB, BOE, and BOJ leaders. Words can move markets just like actions. How it all connects. All these events share one big theme. Money has a price. That price is interest rates set by central banks. Higher rates mean stronger currency but weaker risk assets. Lower rates mean weaker currency but stronger risk assets. Inflation data like CPI and PCE guide rate decisions. Jobs data like NFP and unemployment show the economy's strength. GDP, PMI, and retail sales confirm the trend. OPEC and oil impact energy markets and commodity currencies. Expectations versus reality. Markets move not just on data, but on expectations. If results are better than expected, the currency rises. If results are worse than expected, the currency falls. This is why traders always check the forecast before news. Examples. If CPI was expected at 3% but comes at 4%, that means inflation is hotter than expected. The dollar rises because the Fed may raise rates. If NFP was expected at 200,000 jobs but comes at 100,000, that shows weakness in the job market. The dollar falls because the Fed may cut rates. What we learn: economic calendar events are not random numbers. They are signals of how money, jobs, and prices move in the economy. Central banks read them and adjust interest rates, and traders react by buying or selling currencies, stocks, gold, and oil. In simple terms, the economic calendar is the heartbeat of the market. Subscribe for more videos, and remember, YouTube's got something it knows you'll want to see next. Trust the algorithm. It's smarter than you think.